Ever felt that familiar knot in your stomach when you're staring at a bank statement? Or maybe a pile of bills, that overwhelming feeling where you should understand it all, but it just feels like, well, too much noise. That's precisely why we started the deep dive. Our mission is simple. Cut through the static, take a whole heap of information, and pull out the most important nuggets of knowledge, just for you. Today, we're taking a deep dive into something really crucial, something that touches everyone's life: personal finance. Specifically, how to navigate the, let's face it, often complex world of debt and savings. Our main source for this discussion is this incredibly comprehensive guide. It's a manual on financial education developed by the Foundation Laboral WWB, a prominent organization over in Spain.
Yeah, and this isn't just some abstract theory, right? This guide was actually born from a very real, quite alarming problem back in Spain. Think about this. Back in 2007, household debt there surged by a staggering 12.7%. It reached over 857 billion euros. That's more than 125% of disposable income. I mean, huge numbers. So this manual that was created precisely to tackle that widespread over-indebtedness. It was often fueled by, well, high housing costs, real easy credit, and maybe most importantly, a fundamental lack of financial understanding. So our deep dive today, it's really about equipping you with that foundational knowledge, just like the manual aimed to do for people facing those kinds of challenges.
Okay, so what's our mission for you today? Well, we're going to unpack the core principles of sound financial health. We'll try to understand the different types of financing out there, and most importantly, learn how to, prevent and, if necessary, navigate those difficult financial spots. We'll even explore strategies for building a healthy financial future, thinking about smart saving, maybe some investing too. Right, let's start at the beginning then. Let's unpack the very first tool our sources talk about, the family budget. I know it might sound incredibly basic, but the manual, it highlights this common and, frankly, really costly error. Most people genuinely don't know where their money actually goes.
It's a really good question, isn't it? I mean, businesses track every single penny meticulously, so why shouldn't individuals or families? The manual, it defines a budget as let me get the wording right, a forecasting and anticipation instrument. Basically, it uses your income and expenses to check if you're meeting your financial goals, and it lets you correct things if they go off track, helps you plan for the future.
But why bother? This sounds maybe a bit mundane, right? But the manual lists some really compelling reasons. It keeps your expenses in line with your income. It helps prevent cash flow problems, running out of money before payday. It prepares you for difficult times, gives you real-time control over spending, shows you your true financial situation, not just what you think it is, and it lets you plan for savings or investments, short, medium, long term.
Yeah, and creating one is actually pretty straightforward. It's basically just a double entry table. You've got income on one side, salaries, benefits, maybe pensions, any rental income, that kind of thing, and then obviously expenses on the other side. But the real power, like you said, comes from how you categorize those expenses. To really understand your spending habits, our source breaks them down into three main types. First, you've got fixed expenses.
Okay.
These are the obligatory payments you're committed to. Think mortgage or rent, utilities, school fees, taxes. Missing these, well, it leads to serious problems, right? Service cuts, eviction even.
Like non-negotiable, basically.
Exactly. Then you have current expenses. These are essential for daily life, but they're not, strictly speaking, contractual. So food, transport, clothes, things you need but maybe have some flexibility on.
Okay.
And finally, occasional expenses. These are irregular. Some are unavoidable, like medical costs. But many are discretionary, leisure, travel, stuff you can reduce or even eliminate if you need to tighten your belt.
And the manual, it brings us to life with this really good example. The Munoz family, back in 2007, they had two salaries, brought in 2,400 euros a month. Their total expenses came to 2,261.51. Yeah. So that left them with a 138.49 monthly surplus.
Right.
On the surface, that looks balanced. A little cushion for annual stuff like property taxes.
Yeah, exactly. On paper, it seems fine, tranquil even. But, and this is key, the manual stresses that a budget is a living tool. It's not something you do once and forget about. It needs regular checks, monthly checks, using your invoices, your bank statements. The main goal is to avoid overspending on those current, more flexible expenses and to be able to quickly adjust if your income changes, maybe you lose a job or get a pay cut.
So for you listening, the big takeaway here is probably that if you're not actively budgeting, you might be missing out on some really valuable insights into your own spending, and you could potentially be leaving money on the table without even realizing it. Okay, so moving beyond just the budget, our sources push us to ask some pretty fundamental questions before we even think about taking on new financing. This is where the manual really gets quite direct, urging reflection before making impulsive decisions.
Right, it forces you to pause and really think.
Hmm.
Before you commit, do you genuinely need that thing, that expense, that investment? Or is it just, a whim? Is it an impulse buy you might regret later? What if you wait a few days? Will you still want it just as much? And maybe the biggest question, can you save up for it instead of borrowing? These questions, they're designed to stop you sliding down that slippery slope towards too much debt.
And then we get to the absolute core of borrowing responsibly. Can I actually afford to borrow?
Yeah.
This brings us to two really critical concepts the manual outlines.
Yeah.
Your capacity for indebtedness. They set this at 35% of your net income.
Mm-hmm.
And then your limit of indebtedness. This is the absolute max at 40% of your net income.
And if your total debt payments, everything combined, go over that 40% limit, you are stepping into a high-risk zone for over-indebtedness. The manual really stresses you need to leave yourself some breathing room, a margin for those unexpected things life throws at you.
Let's look at the Munoz family again, but through this lens. Their total debt payments, mortgage, personal loan, credit cards, added up to $971.51 a month. And remember, their income was $2,400 a day.
So what's really revealing here is that their total debt payments were actually slightly over their limit. Their limit was €960 based on that 40% rule. This example from the source, it really highlights something important. Even if you feel like you're managing, like you're covering your expenses month to month, your actual debt load might be unsustainable. It's a definite warning sign for the Munoz family and, frankly, for you listening, to be incredibly cautious before taking on any new financial commitments.
Yeah, that's a subtle but crucial distinction. Now, another really insightful part of this deep dive is how it explores the big life milestones, how they significantly impact our finances and, our borrowing needs.
Oh, absolutely. Things like getting married, buying a home, having kids, or even difficult things like divorce or losing a partner. They fundamentally reshape your financial landscape. Take marriage, for instance. Yes, it can pool resources, which is great, but it also means shared responsibilities, especially if you have joint accounts or cards. The manual points out you're both liable, pretty much regardless of your formal marital agreement.
Okay.
Buying a home, obviously a major asset, but that mortgage, it's a huge long-term commitment. It can seriously reduce your spending power and limit your access to other credit, especially in those early years when you're paying mostly interest. And the manual specifically warns about the risk of rising interest rates, something very relevant today.
Definitely.
Children, well, they drastically increase monthly expenses, don't they? And often credit card balances, too. And then the tough ones, loss of a partner or divorce. Your income often drops significantly, maybe by half, but many expenses like rent or mortgage stay exactly the same. Here, the manual strongly recommends having insurance in place to cover such possibilities.
And that leads us nicely to the importance of insurance itself. Our source describes it as this vital protection mechanism, protection against things like illness, death, disability, even job loss or divorce in some cases.
Yeah, and a really fascinating piece of advice here in the manual is to compare multiple insurance offers. Don't just automatically take whatever the bank suggests when you get a loan. It's about finding the policy that's the best fit for your actual needs, not just ticking a box for the lender.
Right. So for you, this is a really powerful reminder, isn't it? To proactively think about how major life changes could affect your finances down the line. And to have those safeguards, like a well-researched insurance policy, already in place. Okay, so we figured out our budget, we understand our debt capacity. The next critical step is choosing the right financial product if we do need to borrow. And the manual offers some really sharp distinctions here, breaking down the different types of financing and what you really need to look for.
Right. It categorizes financing into two main buckets. Loans, things like personal or consumer loans, mortgages, those urgent quick loans, and private capital loans. And the second bucket is cards debit, credit, revolving, and store cards. But before we dive into the types, understanding the basic elements of any loan is critical. You've got the nominal amount, which is just the money you borrow based on what you need and what you can afford.
Yep.
The amortization period, that's just the repayment term, how long you have to pay it back. The interest rate, which can be fixed, stays the same or variable, often tied to a market index like Euribor, which the manual notes is usually better for the borrower.
Okay.
And then the sneaky ones, commissions and expenses. These are extra costs like opening fees, study fees, early cancellation penalties. They all add up.
And this is where, for the smart borrower, the TAE, or annual equivalent rate, becomes absolutely crucial.
That's exactly right. The TAE, that's the true annual cost of the loan. Why? Because it includes not just the headline interest rate, but all those commissions and expenses too. It really raises a key point. Why would you ever compare loans based only on the interest rate when the TAE gives you the full, complete picture of the cost?
Yeah, it seems obvious when you put it like that. The manual gives a great example, again, with the Munoz family. They were looking for a $15,000 car loan. Option A had a slightly higher nominal interest rate, 7.80%.
Hmm.
But option B, despite a lower rate, had higher fees. When they looked at the TA, option A was actually cheaper overall, 8.3% AE versus higher for option B. It meant a lower monthly payment and less cost in total.
It perfectly shows why comparing that TE is so essential. It's not about the flashy advertised rate. It's about the total all-in cost. You have to look past the headline number.
Okay, let's quickly run through the different loan types mentioned. First, mortgage loans. These are obviously for property, secured by the property itself. Banks typically cap your monthly payment at around 35% of your income, and the loan amount usually won't go above 80% of the property's valuation. And here's an important point they make. Longer terms mean lower monthly payments, sure, but you end up paying significantly more total interest over the life of the loan. The Munoz family, for instance, chose a 25-year mortgage instead of a 20-year one. It lowered their monthly payment, but it cost them nearly $15,000 extra in interest overall. A trade-off.
A big trade-off. Then you have personal loans, generally smaller amounts, under $30,000 maybe, for things like cars, holidays, renovations. Repayment periods are shorter, usually under 8 years. And crucially, they carry higher interest rates than mortgages because they're less secure for the lender.
Right. Now, the manual gives a really stark warning about quick credits.
Oh yeah, these are fast, they're easy to get, often online with minimal checks. And it's but they come with incredibly high interest rates,
Yeah.
sometimes 25%, 30%, even higher. These operations often fly under the radar, lacking proper oversight from national banking authorities. The manual's advice is blunt. Just no, avoid them.
Pretty clear. And similarly for private capital loans.
Right. These are aimed at people who've been turned down by traditional banks. They're often secured by a mortgage guarantee, so you're putting your property on the line. They also come with very harsh conditions, high costs, and again, typically not regulated by the main banking authorities.
So is that convenience, that speed, ever really worth such a huge cost and risk? That's the question you absolutely have to ask yourself.
Exactly.
Okay, then we have cards. Debit cards, simple enough. Payments come straight out of your account immediately. Credit cards you spend now, pay later, usually settle monthly, offer short-term financing, basically. But then, revolving cards. These sound particularly dangerous.
They really are. They let you pay off a fixed amount or just a percentage of your balance each month. Sounds flexible, right? But the manual highlights the trap. The outstanding balance just keeps rolling over, accumulating interest at very high rates, sometimes 25% annually or more. The source calls them, quite starkly, an eternal debt. It warns that if you only pay a small percentage each month, it can take years to clear the debt. And all the while, it's growing with new purchases and all that accrued interest.
Wow, eternal debt. That's chilling.
It really is. It's a critical point for listeners. That small minimum payment on a revolving card, it can create a debt that literally feels like it never ends, costing you way more than a traditional loan. It's a silent trap many fall into.
So the key takeaway for you here, every single financial product has fine print. You've got to read it. Always look at the TAE for loans. And with cards, be incredibly wary of those eternal debt traps, especially revolving cards. Okay, let's shift gears a bit. What happens when things start to go wrong, when debts begin to pile up? Our sources first tackle something quite common, being in the red, having an overdraft on your account.
Right, being in numeros rojos, as the manual puts it. It just means your account balance is negative. Charges have come through, but you didn't have enough funds. Now, banks might cover it, especially for preferred clients, people with steady income whose overdrafts are rare, but it's entirely up to them. It's at their discretion. But the real question is, what makes overdrafts so problematic? It's not just the embarrassment, is it?
No, definitely not. Our deep dive reveals the hidden cost. Overdrafts are essentially short-term loans, but with very high interest rates, often much higher than typical consumer loans. And here's a critical nugget from the Spanish context in the source. Charging a specific commission fee just for the fact of being overdrawn is actually illegal there. You can report it to their national banking authority. Worth knowing your rights. Also, being in the red for more than 90 days, that can land you on those debtor registries we'll talk about later.
Right. And connecting this to the bigger picture, the ultimate goal is to avoid over-indebtedness altogether. Remember that threshold. When your total debt burden goes over 40% of your disposable income, it's often caused by, well, borrowing too much, maybe those impulse buys, or sometimes just unexpected life events hitting you hard.
So for people facing that situation, over-indebtedness, one option the manual discusses is debt refinancing, sometimes called reunification or consolidation. This basically involves rolling multiple loans, especially if you have a mortgage, into a single payment. Often it's structured like a mortgage, aiming for a lower overall interest rate.
Yeah, but it presents this really fascinating trade-off. On the one hand, yes, it usually reduces your total monthly payment, and it can lower your overall interest rate by shifting higher rate debt, like credit cards or personal loans, into a lower mortgage rate. But, and it's a big but, it almost always means stretching out the repayment period, often significantly. So the crucial question you have to ask yourself is that temporary monthly relief worth paying for past expenses, maybe a holiday, a wedding, stuff that's long gone over the next 20 or 25 years?
The Munoz family example illustrates this perfectly. They refinanced, unified their personal loans into their mortgage. It saved them €574 a month immediately on payments. Huge relief, right?
Massive relief, month to month.
However, the long-term cost was an extra $28,000 in total interest and fees over the extended loan period. So it's a very clear short-term gain, but for a pretty significant long-term cost.
Absolutely. And something else the manual warns about quite strongly. Be extremely cautious with those financial intermediaries, companies that pop up promising to sort out all your debts and refinance for you. These companies often operate outside the supervision of national banking authorities. They can charge exorbitant fees. The manual mentions figures over €3,000. And sometimes they actually leave you in a worse situation than before. The recommendation is clear. Try to negotiate directly with your bank first. Or seek advice from reputable consumer associations, not these potentially shady intermediaries.
Good advice. Finally, in this section, we need to touch on the significant danger of being a guarantor, or an avalista, as the source calls it. It might seem like just doing a favor for a friend or family member who needs a loan.
Yeah, but if we connect this to the bigger picture of financial responsibility, being a guarantor means you are taking on the exact same legal responsibility as the person actually taking out the loan. If they default, if they stop paying, the lender will come after you. You are on the hook. And your own assets, potentially even your home, could be at risk. Plus, it negatively impacts your own credit history. It's a really solemn commitment, not just a casual favor. It needs serious thought.
Definitely not something to agree to lightly. So, for you listening, remember, overdrafts are expensive traps. Refinancing can be a powerful tool, but weigh up those long-term costs carefully. And acting as a guarantor, that's a major financial decision with potentially profound consequences for your own financial future. Okay, let's delve into the really serious consequences now. What happens if debt goes unpaid? We're talking about appearing in debtor registries and potentially facing legal asset seizure or embargo.
Yeah, and it's actually surprising how easily people can end up in these registries. Sometimes it's for really small, forgotten debts, like an old phone bill you disputed or something. These are essentially national debtor databases, like the credit bureaus you find in many countries. They list overdue and unpaid debts. The Spanish examples mentioned are RAI and ASNAF.
And why does this matter so much to you? Well, being listed in one of these registries, whether it's for bounce checks, unpaid loans, credit cards, even utility bills or tax debts, it basically means you'll almost certainly be denied any new financial operations. No new loans, no new credit cards. It can really put a stop to things.
Absolutely, but the manual also clearly outlines your rights if you do find yourself on one of these lists. This is important. You must be notified within 30 days of being included. You have the right to access the information they hold about you. You have the right to rectify any errors, and they have 10 days to correct it. And you have the right to cancel your data if the debt is wrong or if it's been paid off. Again, they typically have 10 days to remove it. So it's really crucial to know these rights, right? Are you aware of them if the situation arises?
Knowing your rights is key. Now, the ultimate, most dramatic consequence of unresolved debt is the embargo, the legal seizure of your assets.
Yeah, an embargo is the legal process where a judge or another competent authority can retain or seize your assets because of unpaid debts. And it's not just from big bank loans. It can stem from poor financial planning generally, or even things like unpaid traffic fines or taxes. It shows how wide-ranging financial obligations can be.
And the manual even details the strict legal order in which assets can typically be seized. It's not random.
No, there's a hierarchy. First, they'll go after cash and money in bank accounts. Then, short-term financial assets. After that, salaries or pensions, but only the amount above the minimum wage. There's some protection there. Then comes real estate, businesses, and so on. Importantly, the manual notes that essential household items be sick, furniture, clothing, tools you need for your job are generally protected. They can't just take everything.
Right.
But the source gets very specific about the mortgage default process. It's quite stark. Missed payments lead to increasing pressure from the bank, obviously. After about 90 to 120 days of non-payment, your case usually gets referred for judicial action. That leads to a judge declaring an embargo on the property and eventually it being auctioned off. The manual describes this as a truly dramatic situation of no return.
Wow. So for you listening, understanding how these registries work and the potential for legal asset seizure, it's crucial. Proactive management of your finances, knowing your rights, that can help you avoid these really dire situations entirely. The emphasis, again and again, is on prevention and taking immediate action if problems start. Okay, as we dive even deeper, let's explore ways to actually break that vicious cycle of debt if you're caught in it. Our sources introduce a significant legal tool available in Spain, the ley concursal, which is essentially their bankruptcy law for individuals.
Yeah, this addresses that vital question. What happens when you are genuinely, completely overwhelmed by debt? Since 2004, this law in Spain has allowed individuals, not just businesses, to declare insolvency, and its immediate effects are pretty powerful. It can actually paralyze existing lawsuits against you for non-payment, even mortgage proceedings in some cases. It stops interest from accumulating further on debts. It can allow credit contracts to potentially resume under new terms, and importantly, it enables formal agreements for debt reduction and payment deferrals overseen by a court.
And the manual, it cites this compelling real-world example from 2006. A family in Barcelona declared insolvency under this law. The court proposed an agreement, which was accepted by the creditors. The result, they continued paying their mortgage in full, which was key to keeping their home, but they got a 30% reduction on their outstanding personal loan debts and even had one municipal payment completely waived. That's a significant intervention.
It really is a powerful outcome. However, this deep dive also offers a really crucial caveat here. While the ley concursal can be effective, the process itself is expensive. The manual estimates costs of up to 12,000 euros in professional fees, lawyers, administrators, and judicial costs. And that obviously can be completely prohibitive for families already in severe financial distress. It's a catch-22 sometimes.
Yeah, needing money to declare you have no money.
Good.
So for you, while this bankruptcy law is a powerful last resort, our sources really emphasize that prevention, and taking proactive steps before it gets that bad are far, far better options. And for that, the manual provides this really comprehensive 10-step action plan, a roadmap to get out of this, as they put it.
It really is a practical roadmap. Let's walk through it. The first point is arguably the most critical. Act as soon as possible. Don't wait. Why?
Because debt snowballs, right?
Yeah.
It gains momentum like a runaway train. It just gets harder and harder to stop the longer you wait.
Exactly. What's next on that crucial list?
Following that immediate action, the manual strongly urges you to avoid desperate measures. That means steer clear of those quick credits, those private capital loans we warned about earlier. Their harsh terms will almost certainly just make things worse. And then, number 3, seek professional help. Don't try to go it alone if you're overwhelmed. Consumer associations, reputable lawyers, financial advisors, they can provide crucial, unbiased advice.
Absolutely essential. After getting advice, you need to assess your situation. Really dig into that family budget again. Get a crystal clear picture of your income, all your expenses, every single debt, and any savings you might have. Then, step 5, list all debts. Know exactly who you owe, precisely how much, and what your current monthly payments are for each one. No hiding. And number 6, importantly, prioritize debts. Understand which ones are most critical to pay to avoid immediate disaster, like losing your home, mortgage rent, or essential services.
Right, get the priorities straight. Once you have that clarity, it's about taking action. Step 7, minimize expenses and maximize income. Go through that budget with a fine-tooth comb, cut all non-essential spending, and at the same time, explore any possible way to increase your income, even temporarily. Then step 8, the crucial negotiation phase. Negotiate debts. Contact all your creditors. Confirm the amounts owed. Explain your situation honestly. Express your commitment to pay what you can, and then propose a realistic renegotiation or a temporary deferral plan. And absolutely get any agreement in writing.
That written agreement is vital. After successful negotiation comes step 9. Elaborate a recovery plan. Create a detailed plan, maybe for 12 months initially. Use the breathing room you've created, that newfound surplus, to systematically pay off debts. Start with the highest interest or most problematic ones first, like those revolving cards. Then, once debts are under control, start building an emergency savings buffer. And finally, step 10. Maintain the economy afloat. Once you've stabilized things, you have to maintain discipline. Don't slip back into old habits of unchecked spending or taking on new debt without extremely careful thought and planning. It's about long-term change.
Let's quickly circle back to the Munoz family one last time. Remember, their situation had escalated. They were running a deficit of 457.81 every single month. Deep trouble. But by meticulously applying this 10-step plan, they drastically cut daily expenses, finding €460 in savings from things like mobile plans, leisure, even food shopping. And they successfully renegotiated their debts, including that big move of unifying a $20K personal loan into their mortgage, which saved them €133 a month. They also got a temporary pause on a family loan, saving another €100. The result? They transformed that significant monthly deficit into a healthy surplus of $235.27.
It just shows the incredible impact of discipline, structured action. Over the next 12 months following their plan, they systematically paid off that high-interest revolving card debt first. Then they cleared the family debt, and by the end of that year, they'd even managed to accumulate over €1,100 in savings. Their final budget showed a sustainable monthly surplus of $335.27. It's a really powerful testament to the effectiveness of this kind of structured approach. Even acknowledging the long-term interest costs of that refinancing they did, they got back in control.
Yeah, this whole case study really demonstrates that even when you're facing what feels like a serious crisis, consistent effort, careful planning, and using that budget as a living tool, it can genuinely transform your financial situation. There's a way out. Okay, so we've navigated the often choppy waters of debt, and now finally our deep dives culminates in what feels like the most positive section. Building a healthy, stable economy through saving and eventually investment.
Right. Once you've got debt under control, or ideally avoided it, a really critical shift needs to happen, doesn't it? How do you move from just surviving financially to actually thriving? The manual emphasizes that a key reason to save isn't just abstract. It's to achieve concrete goals. Maybe a down payment on a house, a new car, funding education, or perhaps just as importantly, building that financial cushion, that emergency fund for unforeseen events like unemployment or illness. That provides a really gratifying sense of security.
The manual highlights this powerful shift in mindset, comparing savers and spenders. It's not just about income level. Spenders tend to use cards freely, spend first, and maybe save whatever scraps are left over at the end of the month, if anything. Savers, on the other hand, they make saving a priority. They often pay themselves first, setting aside a fixed amount before they start spending. They control their expenses consciously. The goal for you is to adopt that discipline of a saver.
And the advice for how to save is pretty straightforward, really. First, set clear, accessible goals, short, medium, long term. What are you saving for? Then, commit to a fixed monthly savings amount, even if it's small to start. Automate it if you can. Prioritize your spending. Use that budget. Create and stick to both a monthly and an annual budget. Think twice before every purchase. Is it truly a need or just a want? Avoid those impulse buys. And always, always balance your accounts at the end of the month. See exactly where your money went. Knowledge is power.
Our sources also offer some really practical tips too. Like consider switching from credit cards back to debit cards to naturally limit your spending to what you have. Avoid buying things on installment plans if possible to save on the interest charges. Use online banking and digital services. They're often cheaper or free compared to traditional brand services. Always compare offers for savings accounts or other financial products. Don't just stick with your main bank out of habit. And explore any government subsidies or tax deductions you might be eligible for. Money is always good.
Yeah, as the manual puts it very succinctly, saving is the best way not to get into debt in the first place. It's proactive.
Okay, so once your finances are stable, you've got that emergency cushion built up, and you have a consistent surplus. The next logical step the manual discusses is investment. Making your money start to work for you, make it grow.
Right. But the caution advised here is significant. Investing isn't gambling. You need to analyze the products the financial institution's offering them. Understand the potential profitability, sure, but also the term how long your money is tied up, and crucially, the risk involved. Remember that fundamental principle. Higher potential returns almost always come with longer investment terms and/or higher risk of losing some or all of your capital. The core advice from the manual is simple. Prudence. And vitally important. Only invest through entities that are properly regulated by a national banking authority or financial conduct authority. And diversify your investments. Don't put all your eggs in one basket.
So for you listening, this whole final section is really about consciously shifting your mindset.
moving away from maybe reactive debt management towards proactive wealth building. It's about understanding that every pound, every euro, every dollar saved today is a foundational step towards greater financial freedom and security tomorrow. Well, we've certainly journeyed through the complexities of financial education today, haven't we? From the foundational steps of budgeting and really understanding debt, to tackling potential debt crises head-on, and then finally looking towards building a robust financial future through saving and smart investing. This deep dive into the insights from the Foundation labeled WWB's Financial Education Manual, it's really underscored the enduring power of knowledge, and maybe just as importantly, discipline.
Yeah, and if we try to connect all this to the bigger picture, it seems really clear that financial literacy, it isn't just about numbers on a spreadsheet, is it? It's fundamentally about empowerment. It's about gaining real control over your present financial situation, and maybe even more importantly, your future. It's about avoiding those common pitfalls and proactively creating security and opening up opportunities for yourself.
So for you listening, maybe consider this final thought. If managing your personal finances is, in a way, like running a small business, your own life's business, are you truly acting as the CEO of your own economic destiny? What's maybe one small, actionable step you could take this week, based on everything we've discussed, to apply these insights from our deep dive and take just a bit more control of your financial life?
Because remember, knowledge is definitely valuable, but it's most valuable when it's actually understood and then applied. There's always more to learn, of course, and different perspectives always enrich understanding. But the key is just to start somewhere. Take that first step.
And that's all the time we have for this deep dive.
Thank you so much for joining us on what's been, I think, a really enlightening journey into personal finance. We genuinely hope you feel more informed, maybe more empowered, and definitely more ready to navigate your own financial world.